Hey, what are you studying? What are you guys studying? Hi, what are you working on? So it's 2. I think let's work until 5. Yeah, 3 hours. If we can work until 5, we've pushed. And I think that's gonna be it for the day, because maybe at 5 I can watch 1 or 2 videos, masterclass videos, which is just like real don't. But yeah, I think 5 p.m. I would have put in good time. What are you doing, and until when? Just checking that the washing machine isn't doing its own thing. Outside. I just went out to go and hang my laundry because I washed my bedding. It's hot. snacking on some peanuts. Listen to this if you know bonds. We're giving a 3% coupon bond, which has a upward sloping yield curve. Maturity of the 5-year bond at par has a yield of 3 and pays 3% coupon. So it's priced at 100 Rand. 10-year bond has a yield of 3.5, and because it pays 3% coupon, the price is going to be lower. 15-year bond, 4% yield, lower price, all the way up until a 30-year bond with a yield of 5.5, price of 63. And it says a bond investor with an investment horizon of 5 years could purchase a bond maturing in 5 years and earn the 3% coupon, but no capital gains because the bond is priced at par, right? However, assuming no change in the yield curve over the investment horizon, the investor could instead purchase a 30-year bond for 63.67, hold that for 5 years, and sell it for 71. So it would have rolled down the curve from being a 30-year bond to a 25-year bond, where the 25-year bond is 71 Rand and the 30-year bond was 63. So there's the price appreciation, earning an additional return beyond the 3% coupon over the same period. The risk of such a leverage strategy is the possibility of an increase in spot rates, because you would borrow the cash to buy the longer dated bonds, hold them for the term, and then sell them. The risk, of course, is the change in the yield curve of the investment horizon. So that is the assumption here. I'm going to ask my team why I can't do this in real life on my paper portfolio. I think it's a good idea, but I think there's something I'm not understanding, because it obviously is not this easy, right? Oh, but this thing is hard, eh? I'm going to go into the swap rate curve now, and then there's going to be spread measures, and then term structure theory. Wow. It's very hard. I think before I go to that, actually, before I do the swap rate curve, on spot and forward rates, I'm gonna go and do a masterclass. Then I'm gonna do the quiz for both. 2 masterclasses, 2 quizzes. Then I'm gonna start a swap curves. So there's gonna be some noise. But I think maybe before that, let me just show you guys my performance tracker. It's not where I want to be, but it is what it is. Yeah. So I'm at 15% right now, and these are the activities that I've completed. I haven't done any exams, and then on the question bank I've only gotten 65%. And that is my question bank questions answered, and then those are the percentages. But what I want to actually show is on the Q bank, there's this nice feature where I can say compared to others. So it shows that I'm on 65% for quants, and I'm on 65% for ethics, where everyone is on 75 on the quizzes. And then yeah, so it's good. I mean, it's important to know where you are relative to others because of the way that the exam works. So this is where I'm saying I'm doing the masterclass, because according to the activities, that's how it follows. And then on Schweizer notes, these are the two that I've just completed now. Yeah, so we're just gonna go back to the study plan, and then we're gonna do on the activities, we're gonna do the two master classes.
Well, hello friends and welcome to fixed income. Now, fixed income tends to be fairly quantitative, so it gets into a lot of formulas, and so it requires us to make sure that we dot our I's and cross our T's. We'll start out with the basics, and in fact, what you're going to see is something that you have probably seen at level 1. Do keep in mind that if you have forgotten the material from level 1 or it is relatively hazy, don't worry, we are going to go over it again. And then we'll move on to more complex material that builds on those foundations. All right, so we are going to talk about the spot and forward rates. Again, spot rate is if I'm taking a loan today and repaying it in a certain period of time, let's say 3 years. Spot rate is only used if there is no intervening cash flow. So they're also called as bullet rates. So you take out a loan at time 0 and repay after 3 years. That would the rate underlying that loan is a spot rate. If you are, however, locking in, so you're entering into a forward contract to lock in a rate for future borrowing. Your borrowing starts 1 year from now, and the borrowing ends after 2 more years. So the loan period is 2 years. So if you are doing a deferral on borrowing, but locking in the rate up front at time 0, that would be a forward rate. So forward rate are market traded rates. They are an obligation as well as a right, which means that they are not like options where if the forward rate that you locked in turned out to be a bad deal, you can back out of it. No, you can't. So they are commitments rather than options. So both again spot and forward rate, rates are always quoted in annual terms. So we kind of already know this. Remember yield to maturity that you have seen in level 1. Yield to maturity is for a bond. Let's say a bond has a 30-year maturity. When you calculate the yield to maturity, that is an annualized rate. It is not the rate over that 30-year period. So same principle applies. Always, all rates are quoted in annual terms, regardless of the term of the loan involved or term of the underlying contract. All right, so 2 LOSs, we are going to talk about zero coupon rates, also called as spot rates. We also use the label bullet rates. We're going to talk about that. And those are obtained from Parker using something called as a bootstrapping mechanism. And you'll talk about relationships among these rates. These rates are mathematically related from no arbitrage principle. So again, spot and forward have to be related mathematically, otherwise there would be arbitrage. Because remember, forward rates are not expectations. They are not expected future rates. They are contractually committed upfront at time 0, same time as you see the spot rate, which also are market traded rates. You can purchase securities that offer that spot rate. Now, spot rate is, again, zero coupon bond or bullet bonds. They are no coupon is basically implies no reinvestment risk, and that is just the definition of what a spot rate is. We use the yield to maturity if I'm looking at the return on a coupon bond over a certain time horizon, over a certain maturity period. But here we are talking about spot rate, not yield to maturity. There is a relationship between spot rates and yield to maturity. So now you can use spot rate to calculate the price of a zero coupon $1 face value risk-free bond. And that is simply 1 divided by 1 plus SP T being the maturity of that. Zero coupon bond. So it is nothing other than present value factor, or also called as a discount factor. It is present value of $1 discounted over how many periods that you are discounting, how many, whatever the value of uppercase T is. Now, the spot yield curve or spot curve is simply the plot of individual spot rate relative to their maturity. So you have the spot rate on the y-axis and maturity on the x-axis, and you just plot it out. That will give you the shape of what is called as a spot yield curve or spot curve. And I don't even like to use the label yield because it can be confusing to think of it as a yield to maturity. They are very different. Obviously, spot rate curve changes continuously. Rates fluctuate based on trading and market, and so you see, depending on the instrument involved, you see the fluctuations in the rates over time. Now, forward rate is again the annualized rate, as I already mentioned, on a loan to be initiated at a future time period. Forward curve is again a plot. Of forward rate vis-a-vis the maturity of the forward contract. So if you are initiating a forward loan starting 1 year from today but maturing or ending in 10 years, then that will be a forward rate representing time period 1 through 10. And so you plot it against the maturity and you get a forward curve. There is a systematic relationship between forward rate curve and spot curve, which we will exhibit later on. Now, lowercase f we are using as a notation for denoting rate. Again, all rates are annualized, and we use two time subscripts J and K. Lowercase j is simply the starting point of the loan, and lowercase k is the term underlying the loan. I use the term loan in a very loose sense. It could be representing a bond, which we'll see in just a second, where we are trading a bond in the forward market, and so the rate underlying that bond would be a forward rate. So think of it again as a rate applicable to a loan, but it can be any debt instrument as well. All right. Uppercase F is used to denote the price, and J and K again has the same connotations. J is when the delivery occurs. So remember, you're initiating the forward contract today. Delivery of that bond is going to be made at time J, sometime in the future. And the short party, the party that has agreed to sell at a fixed price of uppercase F, so the short party delivers a K period bond. And here we are defining very specifically in this instance that it is a $1 par value zero coupon bond. So these are again simplifications that we can then relax later on. But right now, because we want to illustrate the relationship between these spot and forward rates, we are keeping everything simple. The underlying bond is a $1 face value bond and does not have any coupon. Now, all of this pertains to benchmark rates, and benchmark rates are important. They are used to denote default-free rates. So in the U.S., we use treasury rates. In other countries, they have their own sovereign rates that apply. All right, the forward pricing model simply says that price today of a bond, remember uppercase P is price, and it is the spot price. So uppercase P again is the spot price of a zero coupon $1 face value bond. Is simply equal to a present value factor. Remember, earlier we said those prices is nothing other than present value factor or discount factor. So you're multiplying the forward price by a discount factor. And the discount factor is present value at a spot rate for J periods. J denotes when the delivery of the bond occurs. Remember,
starting with J. It's always starting with J.
forward contract, you deliver the bond after J period. So you are multiplying it by discount factor for J periods, and you get the price today. Nothing fancy. If I was going to buy the bond today, I'll pay the price uppercase P and then J plus K. And say, for example, J is equal to 3 and K is equal to 2. Then I'm looking at a 5-year bond that I can buy today in the market at P5, or I can lock in a forward price for the same bond, but the delivery occurs after 3 periods. So the delivery will occur after 3 periods. I still get a 5-year bond, which now only has 2 more years remaining to maturity. The present value of that locked-in price today is going to be my the price I'm willing to pay today. Otherwise, there will be arbitrage. Otherwise, if there is a difference I can undertake an arbitrage and make risk-free money. This is all risk-free rates, keep in mind. So we are using benchmark rates in our discussion. We'll talk about credit risk later on in a different reading. So it gives you an equivalence of how the spot price is related to forward price, and that is the forward pricing model. Now, similarly, forward rates are related to spot rates, and that is called the forward rate model. The basic implication is if, say, for example, I have my investment horizon of 2 periods, I can either invest for the 2 periods at a 2 period spot rate. Again, remember, this is the annualized rate. If I invest for 2 periods, it'll compound for 2 years. So I can invest for 2 periods, or I can invest for 1 period and then roll over that 1 period after it matures into a locked-in forward rate. Keep in mind that all of this is market rated. In other words, they're contractually bound, and there is no risk involved. There is no expectations error. We will get that forward rate when the maturity occurs after 1 period. And so what I will get in scenario 1 is 1 plus S1. That's the value my $1 will compound to, multiplied by 1 plus F. And this is 1 because it is the forward rate at time period 1, starting at time period 1 for a 1 period loan, in this case 1 period bond or 1 period investment. And that will be equal to 1 plus S2, and I have compounding, remember, for 2 years. And that math is essentially forming this formula. Now, I am not a big fan of this subscript because
it is quite confusing.
they tend to be intimidating initially when you look at a formula. You're not going to memorize this JK thing. It's easier for exposition, and that's why we use it in writing the notes or creating the slides. But on the actual exam question, they will spell out what they are looking for. So you're not, they will not say test your ability to recall what J really meant and what K really meant. So, but of course, if you can remember it, it's easier because then you can essentially remember the formula nicely. But I went through the intuition behind the formula. Now, I erased it, so let me rewrite it. And so this was 1, 1. And so if I want the forward rate, I can calculate it. Divided by 1 plus. S1. And in this case, the forward rate applicable in my simplified example was rate for a 1 period. I'm reinvesting from time 1 to time 2. So it was only 1 period, and so it goes, has a superscript or raised to 1. But if it was for 2 periods, it will be superscript 2. If it was for K periods, it will be superscript K. So nothing fancy. As you can see, the higher superscript is always going to be in the numerator. Otherwise, you will get negative forward rates, which will tell you you made an error. Now, so buying a 5-year zero coupon bond, so you get a 5-year return again on an annualized basis, compounded over 5 years of S5. And versus buying a 2-year zero coupon bond at S2 and reinvesting the principal at a locked-in forward rate F23, meaning start point of that reinvestment is at time 2, and we are reinvesting for 3 periods. And so this is exactly 1 plus S5 raised to 5 is equal to 1 plus
S2
S2 raised to 2 times
1 plus F2 3
3 raised to 3. So that is what this implies. So relationship between spot and forward rate. Now you already learned how to calculate the forward rate given the spot rate curve, so you'll be familiar with it. But if you had forgotten, here it is. Now a simplified version is ignoring the exponent and using it as a multiplier. So 5S5 is equal to 2S2 plus 3F23. So this is a simplification. You get the result if you're calculating the forward rate. So the forward rate F23 will be equal to 5S5 minus 2S2 divided by F23 and a multiplier of 3, which is the value of K in our equation. So this is a simplification. If you do a few examples, you'll be able to do it in your head, and you'll see the value getting closer, especially for shorter periods of time.
Okay. It's a nice little shortcut.
The K value is small and for lower rates. All right. Now, calculating forward price. And forward price is simply, remember, at maturity, we still have that $1 zero coupon par value bond. So you have a $1 that you're going to receive at maturity at time T, J plus K. And J is again the start of the forward when the delivery occurs for the forward instrument, the bond, and then K is the remaining maturity of that bond. So you get that time J plus K. So the time period here is still K periods. So you're buying for K period. The delivery is postponed for J periods because it is a forward contract. Now, the forward price is simply present value at the underlying forward rate for K period. So I'm just calculating present value just as you would do, but instead of spot rate, we are using forward rate. Always remember, spot rate is applicable if the underlying loan, and again, loan is used loosely, underlying loan starts at time 0. Here, the underlying loan starts at time J, so I need to use the forward rate starting at time J. And the spot price of the same $1 face value zero coupon bond can be calculated, as we already know, is discounted for T, uppercase T period here. That formula that we already saw here, T is simply equal to J plus K. Now, we'll look at a few examples to solidify these ugly formulas.
Yo, this thing is hard.
So consider a 2-year loan beginning in 1 year. So the underlying rate is F12. J is the starting point of the loan, and K is the time period involved, the loan term. And so we are given a 2-year loan beginning in 1 year. So as I told you, they'll spell it out for you. You don't need to know what J is and what K is if you already understand the mechanics without memorizing the formula. 1 year spot rate is 7%, 3-year spot rate is 9%. And so we can do a graph of timeline, and we have a 3-period timeline, and the underlying is starting at time 1 and ending at time 3. So that is given to you. That is what we are trying to find out, the rate applicable. So we are calculating the rate in later on here. We are calculating the forward price. We'll see how that is done. But we need two things: the non-overlapping spot rates corresponding to the missing forward rate. So the first spot rate that we need is S3, and the other spot rate that we need is S1. Now the curriculum uses lowercase z for denoting spot rate. It doesn't really matter. I prefer to use S, but you know, the notation, as I said, is not critical, not important, at least for the exam. All right, you're asked to calculate 1 year discount factor. Discount factor is simply present value $1 if the $1 was received at the end of 1 year. So the 1 year discount factor is simply 1 divided by 1 plus the 1 year spot rate, given to us as 7%. So 7%, and because it is 1 year, I don't need to compound it. It is 1.07 raised to 1, which is same as 1.07. So the present value of $1 discounted at 7%, if you use your financial calculator, you should get 0.9346. That would be the present value. Now, the second question is calculate the 3-year discount factor. So I'm going to use the 3-year rate, again calculating the present value of $1 received after 3 years. So 1 divided by 1.09, now you're raising it to 3 because it is for 3 periods. And as expected, the present value will be lower because we are discounting for 3 years. Finally, so this is nothing other than prices. So 1 year discount factor is same as P1, and the 3-year discount factor is same as P3. Uppercase P denoting spot price of a zero coupon bond with a maturity of T. For 1 year bond, the maturity is 1 year. 3-year bond, the maturity is 3 years. The forward price of a 2-year bond issued in 1 year. And so we are looking for uppercase F, 2 and 1. The bond will have 1 more year remaining to maturity. And if I use the forward pricing model, I should be able to get, remember, forward pricing model here. Pj plus k is equal to Pj divided by Fjk. And so here it is P3 is equal to P1 times F12. So all I'm going to do is to rewrite this equation, and because I'm asked to calculate the forward price, F12 is equal to P3 divided by P1, just algebra. So dividing both sides of the equation by P1, we get the forward price. So that is exactly what we are going to do. So take times F12. So all I'm going to do is to rewrite this equation, and because I'm asked to calculate the forward price, F12 is equal to P3 divided by P1, just algebra. So dividing both sides of the equation by P1, we get the forward price. So that is exactly what we are going to do. So take the lower forward price, that's the lower discount factor because that is the P3, and divide it by P1, and we get 0.8262. That will be the forward price. All right, so we looked at the forward.
I'm tired. I am very tired.
otherwise now we're calculating forward rates. Now, one thing you will see here is you are given 3 spot rates, Z1, Z2, and Z3. So
someone yesterday was mentioning with Dr. Shaw for FinMax and advice and whatever. He always used to tell you draw a timeline. If you go to him and you're stuck on something and there's not a timeline on your paper, he just says draw a timeline, then we can talk. Yeah, I still do that.
the spot curve, if I were to draw it out, is upward sloping. It is rising from 9% in year 1 to 10% over 2. Forward rate, double check. Yes, the forward rate is above. 1 times 2 times is 11%. And the to get to the non-overlapping period, I need S1.
Why am I not
that is
getting
9%. So the 2-year period is F12. Starting at time period 1, and it
F11, I got the 11. F21, 13. I got that wrong.
is for 2 periods. So F12 is 3 times S3 minus 1 times S1. And now you are going to divide by 2 because K is 2. It is a 2-period forward rate. So you divide that by 2. So 33 minus 9 will give you 24 divided by 2 is 12.
I got that 12.
So we'll double check. I just did this using approximation to do the actual calculation. Once again, your given 3-year spot rate is 11%, 2-year spot rate is 10%, and 1-year spot rate is 9%. The first question is calculation of F11. So I need this rate.
Hey, what am I doing wrong here then? F21. Starting in 2 years' time.
So I need to use the 2-year rate and the 1-year rate in my formula, 1.10.
Okay, is that the first one? Yeah, that's fine.
Square divided by 1.09. The second part, this part is used for the last question, which we are going to see. So I get 11.01%. Remember, that is relative to 11% approximation. All right. These rates are kind of high, and so you see the approximation having a decent error of 1 basis point. But if you were to have lower rates, then you won't even have 1 basis point of approximation error. The second question is.
This is one I got wrong. What do we want? F12(1). Which means this 1 plus S3 squared. Yeah, that's what I did. Plus, or is it S2 squared?
To calculate forward rate on a 1-year 0 2 years from today. So I'm going to use 11% and 10% in my equation. And so this is 1.10, doesn't matter, 1.1. And I get 13.03% versus
Yarr.
Is 13% is an approximation. Finally, the last one, you're doing a forward rate for 2 periods for loan starting in period 1. So I need again the 3-year rate and a 1-year rate. So 3-year rate divided by 1-year rate, exponent, remember, corresponds to the maturity or the term involved. And this will be 1 plus f1 squared. So I'm kind of combining some steps. If I take a square root of that ratio and then subtract 1, I will get the real answer of 12.01, again, relative to the approximation of 12%. So as I said, if you do the approximation, you will get the right answer, and you will be, with a few examples, you'll be able to do it quickly in your head. And again, this is nothing new. You've seen this in level 1. All right, so now we looked at the relationship between spot and forward rate. They are mathematically linked by principles of no arbitrage. And we also talked about if the spot curve is upward sloping, the forward rate curve will be above it. If the spot curve is downward sloping, then the forward curve will be below it. But what if the spot curve is flat? Rates are the same, spot rates are the same for all maturities. Well, then the forward curve will be same as the spot curve, and there will be also a flat line superimposed on the spot rate curve. All right, now let's talk about the...
I'm hungry. Let me make some food.
Concept of yield to maturity. Now, yield to maturity with zero coupon bond will be seen as a spot rate. Remember, the other name for spot rate is zero rate or zero coupon rate. So, when the yield to maturity is calculated for a zero coupon bond, you are essentially calculating the spot rate. For a coupon bond, though, the spot rate will not be same as a yield to maturity if the underlying spot curve is not flat. Now, yield to maturity is the weighted average of underlying
Cash flows.
spot rates.
Spot rates.
So, you're not going to calculate it using a formula, using a weighted formula, but conceptually, I think it is important to understand that. So, yield to maturity is simply a weighted average. So, if I was looking at a 3-year yield to maturity on a coupon bond, then that 3-year yield to maturity will correspond to weighted average of S1, S2, and S3. So those are the underlying time periods involved. So the spot rates for those 3 periods will be averaged using some weighted mechanism to arrive at the yield to maturity.
Okay.
Now, the weights are basically proportional to the cash flows. In fact, really, technically, it is present value of cash flow, but think of it as cash flows at each point. For a bond, your cash flow for a 3-year 4% coupon bond, supposing face value is $100. So what do you have as cash flows? First year, you get the coupon of $4. So 3-year coupon rate 4% and equal to 3, and face value or par value is 100. All right. So at time 1, you get $4. Time 2, you get $4, and time 3,
You get 104.
you get the par value plus the last coupon.
Mm-hmm.
So what this tells me is the weight, if it is proportional to the cash flows, then the weight of the third cash flow will have a higher weight. So in other words, when I calculate the weighted average, S3 will get the highest weight. So in fact, the yield to maturity will be close to the spot rate corresponding to the maturity of the bond. And we'll see that mathematically shape up in just a little bit, but some key takeaway, mathematical relationship between yield to maturity and spot rates. So here is a quick example. You are given, use the spot rate as given, same spot rate as our previous example. So So the spot rates are 9, 10, and 11%. The bond is discounted at 9 and calculating present value. You can do this on the second one. Feature value is still 5, n is equal to 2, I slash value 3, which is a present value of 105. So you get a present value. You add up these three numbers together, and you get a total present value to be 85.50. So this 100 sterling, because these are annual coupon, is look at the spot rate highest values. The second check is the yield to maturity on, so it should be close to 11, is lowest and highest, and should be close to the highest value. More likely than not, you still have to do the calculation because exam writers are smart and they are aware of the shortcut, and so they want you to do the work. The concept of expected return. So if you purchase a bond, and supposing the bond has a yield to maturity of 10.93%, it's a 3-year bond. And your question is, will your return, your holding period return, your actual return, realized return, will it be exactly 10.93%? Well, the actual return will be equal to the yield to maturity only if 3 conditions are satisfied. There are 3 clear conditions. One is the requirement that the bond is held until maturity. So if you're buying the 3-year bond and then you sell it after 1 year, because the rate's going to change, you have an uncertain exit price, you have an uncertain selling price of the bond, and your realized return will be different. You will have the $5 coupon plus whatever you sell the bond for. Your holding period was one year. So that is the first condition that needs to be satisfied. You need to hold for until maturity. The second condition, there is no default on the bond. So if the bond is given to be default free, the second condition would be satisfied. The second condition says the coupon and principals are received on time, and that obviously implies in plain language that the bond is not going to default. And then the third condition is all coupons are reinvested at the original yield to maturity. So if you're getting coupon payments, there is something called as a reinvestment risk. You learned that already. And there is an uncertainty. In our bond, we are getting 5 sterling coupon every year. At the end of first year, we we got that 5 sterling, we are going to reinvest it. If our investment horizon is 3 years, we are going to reinvest it for 2 years. Well, there is uncertainty about a 2-year spot rate at that time. So there is a reinvestment risk, and that uncertainty may result in your actual return differing from the yield to maturity. And so that condition is the least realistic assumption. Obviously, for what bond would that third condition really not apply? Well, if it is a zero coupon bond, if the underlying bond is a zero coupon bond, there is no assumption about reinvestment of those coupons. There is no coupon. So if the bond is default free, you hold it until maturity, and it is a zero coupon bond. Yes, under that condition, the yield to maturity, which is same as what? The spot rate of the bond, because it is a zero rate, the yield to maturity will be equal to the actual return of the bond, again, assuming you hold it till maturity. All right. Quick example, which of the following statement concerning the yield to maturity of a default-free bond is most accurate? So second condition satisfied. Remember, the second condition is the coupon and principal is received on time. There is no default. It is a default-free bond. Now, the statement is the yield to maturity of such a bond. Choice A says equals the expected return of the bond if the bond is held to maturity.
Yes, that is true. Bond is held to maturity, default free. It doesn't say if you reinvested the same condition. Can be viewed as a weighted average of the spot rate applying to it. No, because there's the reinvestment rate of the coupons. Because with the realized return if the spot curve is upward slope and rather flat throughout the life of the bond. I think A.
So this satisfies condition 1. But
what about reinvestment risk of
not
the coupons?
Condition 3.
Yeah.
So choice A is not accurate. It makes a strong case, but it is not accurate. It's a good distractor. Choice B says can be viewed as a weighted average of spot rates applying to its cash flows. And that is exactly correct. Remember, for a 3-year bond, the yield to maturity of a coupon bond is simply the weighted average of those underlying 3 spot rate.
That's a good question.
So that is choice B, and that is correct. Let's let's look at choice C. It will be closer to the realized return if the spot rate curve is upward sloping rather than flat through the life of the bond.
No.
And that is not a requirement, and so that is not correct. So choice B is your correct answer. Now, the concept of par rate. Par rate is essentially the yield to maturity for bonds that are trading at par. And there is a special significance to this par rate. Remember, if a bond is trading at par, the yield to maturity will be the same as
the coupon rate.
And so I don't even need to, bring out my trusted Texas Instrument calculator to calculate yield to maturity. If I know the coupon rate, that's the par rate, as long as the bond is trading at par. So it's easier to calculate. Don't even need a time value of money calculator. But more specifically, more practically in real world, the par rates are of special significance when we want to create a spot rate curve, which we are going to show in just a second. What is the special significance of par rates when we're talking about benchmark or risk-free rates? Well, if the bond is not trading at par, there are quirks in the tax code which imputes amortization of, if the bond is trading at a discount, then amortization of discount over the life of the bond, or amortization of premium over the life of the bond. And the tax code provides incentives to amortization of discount versus, amortization of premium versus amortization of discount. Nobody wants to pay taxes earlier than they have to, and so premium bonds discount bonds are unattractive from tax code purposes, and premium bonds are attractive from tax code purposes, or vice versa.
Look at my sponge ball. It's giving post buffet vibes. Oh, I'm so hungry.
I can't recall exactly. It's not something that you need to worry about as far as exam is concerned. But uh, the main crux is I want the cleanest rate from the market for benchmark rates. And I don't want any additional risk premium for tax advantage or disadvantage embedded in that rate. And that's why par rate curve is considered to be a clean curve for benchmark rates. So obviously, for a par bond that has only one period remaining, the yield to maturity is the spot rate, which is seen as again the coupon rate on that bond. So we are going to see how these par rates are used to create the spot rate curve. Remember, spot rate is the zero rate or yield to maturity on zero coupon bond. If the government has regularly issued zero coupon bonds, then I can basically get that from the market data. Yield to maturity on those zeros will give me my spot rate curve. But it is not so for most government issues. So you can try to, for the US market or EU market, you can try to use strips, treasury strips, for example, to derive the spot rate curve. But they are not they are not as liquid as on the run par bonds. So that is why par rates are used. And so the bootstrapping process, again, remember, par rates are yield to maturity. So that should immediately trigger one thing that we talked about already. Yield to maturity is a weighted average of underlying spot rates.
Yeah.
All right. So you are given the par rate for 1, 2, 3, and 4. 5%, 5.9, 6.91, and 7.81. You're asked to calculate the underlying 4 spot rates. So for a 1 period bond, the yield on the bond
Is the spot rate.
is the same as the spot rate. So 5% is the 1 year par rate. Now, before we proceed any further, you are given for a 2-year bond, par rate is 5.97% face value. Okay, assuming that, it doesn't matter if I assume $1 face value, but assuming $100 face value, what will be the coupon on this bond? Well, because these are par bonds and these are par rates, the coupon will also be the same as the par rate.
Yeah.
Because bond by definition is trading at par, that's why it's called a par rate. So the coupon for 2-year bond, 2-year bond with a coupon rate of 5.97%, that would be trading at par. Similarly, 3-year bond with a coupon of 6.91%, should trade at par. So we know the maturity of the bond, we know the coupon amounts on the bond, we know the
future value,
present value of the bond, that's par, $100. So all we need need to know is the discount rates that is applied to these cash flows.
Yeah.
So for the second bond, the two cash flows, $5.97.
Yeah, so that's 100 is equals to 5,97 plus Z1, 100 plus 5,97 Z2 squared. 100 plus 5,97 plus 5, 5,97 plus Z2 squared. Z2
And then the next cash flow is 105.97. Remember, it is a 2-year bond. I'll discount the 597 at 5%, the 1-year spot rate, which we already know from step 1. The reason we call it bootstrapping is we are using the result of step 1 into step 2, and similarly using the result of step 1 and 2 in step 3. That is what is bootstrapping. So we don't know what the S2 in institute label is Z2, and we don't know the value of that. But I have one equation, one unknown. So I can calculate the first term, 5.97 divided by 1.05, and then take it on the left-hand side, meaning subtract both sides by $5, and I think it will be 69 cents. So this will be 5.69, I think, 597 divided by 1.05. And then subtracting both sides, I get 94.31. And the term remaining on the right-hand side is 105.97 divided by 1 plus S2 to the square. Now I'm going to multiply both sides by 1 plus Z2 square. So it becomes 94.31 times 1 plus Z2 square is equal to 105.97. On the right-hand side, 1 plus Z2 square cancels out because I'm multiplying by that value. And then 1 plus Z2 square is equal to 105.97 divided by 94.31, dividing both sides by 94.31. And whatever value I get, because it is 1 plus Z2 square, and whatever value I get on this side, solving it, I need to take square root of it, and that will give me 1 plus Z2, and then finally subtract 1, that will give me Z2, and it turns out to be equal to 6%. Now, your 2-year spot rate is 6%. 1-year spot rate was calculated as 5%, essentially directly given because that was the 1-year par rate. 2-year spot rate is calculated by us via bootstrapping to be 6%. Double check. 2-year yield is 5.97, and that should be between 5% 1-year yield and 2-year, 1-year spot rate and 2-year spot rate.
And it is.
So it should be between 5 and 6%, and as you can see, it should be close to 6% because the second spot rate
Which is the cash flow.
takes the higher weight in the yield to maturity calculation for a 2-year bond. So it appears to be all copacetic. It appears to be all done properly. Of course, it is. So then we move on to the third spot rate bootstrapping. So for the third one, what is the coupon rate? It is 6.91%. So we have 6.91 discounted for 1 period at the 1-year spot rate, 5%. The second 6.91 is discounted for 2 periods at the second spot rate, which we just calculated to be 6%. And then finally, the last cash flow is 106.91, which will be discounted at the unknown Z3. Again, one equation, one unknown. So you keep on solving. So you take the present value or the first 2 terms, whatever value you get, subtract both sides, you get about 12.73. So you subtract both sides by this 12.73, you get 87.27 on the left-hand side, 106.91 divided by 1 plus Z3, and do your algebra magic. You multiply both sides by 1 plus Z3, and divide both sides by 87.27 into one step. That's what you're going to get. And now I need to take the third root of this fraction. So whatever you get, take the third root, and or you can use the x raised to y key in your calculator, where y is 1/3 or 0.33333. Either way, whatever value you get after taking the third root, don't forget to subtract 1. And you get the third spot rate to be 7%. Now check, does that conform to the information given to us? The yield to maturity is 6.91, and it should be between the lowest spot rate, which is 5%, and the highest spot rate, which we just calculated, be 7%. It is. And not only that, that 6.91 is pretty close to 7%, the spot rate corresponding to the maturity of the 3-year bond. Finally, the last one, the coupon rate is 7.81%. Now you're going to plug in the spot rates that we bootstrap. 6% for second year, 7% for third year. Only thing missing is Z4. Do our magic with math and take the fourth root of that final ratio. Don't forget to subtract 1, and you get the final spot rate to be 8%, upward sloping. And you start with 5, 7.81. That is the yield to maturity or par rate. And you see that it is indeed between those two values. And not only that, it is close to the last spot rate of 8. All right, let's move on to the next part of this, next module of this reading. So hopefully you understood this, kind of a little bit of involved math. You hopefully understood. Otherwise, do a lot of practice question and.
Yeah. I just did that. Yeah.
Hello, friends, and welcome. Your assumptions and your expectations pan out, then indeed you will make money. Now hello, friends, and welcome to fixed income for your remaining zero coupon 5%.
Okay, I think I'm gonna do the quiz. I'm so tired. I'm so tired. When the yield is downward sloping, the forward curves are most likely to lie below the spot rates. The model that equates buying a long maturity 0 coupon bond to entering into a forward contract to buy a ZCP bond that matches the same time is known as the no arbitrage. Forward arbitrage. What? About 50%. Forward arbitrage model. Forward pricing model. come back for this one. Oh, I need to. How many of them? Probably like 4, 5. Only 4. Oh my god. Only 4. If I can get. I think I was too ambitious for the weekend. Because now I'm on 15% and I'm dying. And I thought I wanted, what, 30% in a weekend? I was high on crack. That's good. That's good, man. I don't know why it kicked me off. It only said 35 minutes. We've been here for what? 2 hours. Fixed income is killing me.
Hello friends and welcome back, and now we are ready to talk about the second part of the relationship between spot and forward rates. So when we start out with the LOSs that we're going to cover here, so we have 2 LOSs, and one of the strategies that we're going to talk about is an active trading strategy and called the rolling down the yield curve. We'll talk more about it. And the main thing here is we'll first, they're interrelated assumptions, interrelated learning outcome statements, because we are talking about what is the forward rate and what actually occurs in the future. So remember, at any point in time, your forward rates are derived from the current spot curve. Now, forward rate are market prices, meaning they are tradable. They are not expectations. Now, as time goes by, supposing we are looking at forward rate for 1 year loan starting in year 1, not starting today, but starting 1 year from now. Well, a year has gone by, and now in reality, the market rate may be higher or lower than that original forward rate. So that is called the evolution of the spot rates. So what will be the spot rates? Will they always be equal to what is implied in the current forward curve, or will they fluctuate? We already know that they will fluctuate, they will change. So forward rate is currently the overall aggregates market expectations. It may, things change in the time period, and therefore the actual spot rate in the future may be different. All right, so keeping that in mind, the first bullet point here is very, very, very powerful. And that says the return on a long-term bond, meaning a bond with a maturity more than 1 period or 1 year, is always equal to the 1 year risk-free rate if the spot rates develop as predicted by today's forward curve. Now we are still talking about default-free bonds, so that is why the return is risk-free rate. So, if your holding period is 1 year and you buy a 10-year bond. Well, what happens? At the end of 1 year, you're going to basically be in the market to sell that bond that you purchased, and now that bond will have a 9 years remaining to maturity. There will be an uncertainty of price. If it was a 1-year bond, there is no uncertainty. You get your par value back because that was the maturity of the bond. But if it is a 10-year bond, there will be uncertainty about the price of that bond in the future because our holding period is less than the maturity of the bond. Now, the statement says if the spot rates develop as predicted by today's forward curve. So if it is a 10-year bond, okay, if it's a 10-year bond and we want to sell it at the end of first year, well, we are basically looking at the forward rate currently available to us for a 9-year bond 1 year from now. We can lock in that rate through market transaction. Now, if the spot rate at time period 1 is exactly the same as that forward rate that was implied in the spot curve when we purchased the bond, then your realized rate of return will be the same as purchasing a 1-year bond. So there is no risk premium that you would earn if, again, with the key assumption, if spot rates develop exactly as predicted by today's forward curve. Now, let's, before we move on, because this is an important relationship, I'll show you something. So consider just a simple example, zero coupon bond. There are, the spot rate curve is S1, 1 period spot rate is 3%, 2 period spot rate is 4%. And using our calculations, our forward rate is approximately equal to 5%. So 2 times S2 minus 1 times S1 divided by, so remember here, 2 minus 1 is our K, and that is the K that is the divisor. And so you get 5% as your approximate forward rate. That would be the rate 1 year from now for a 1-year loan. So that is F11. Now, you have 2 bonds that are available for investment. Your holding period is 1 year. Your investment horizon is 1 year. Both bonds have a par value of $100. They are zero coupon. It doesn't matter. We're just keeping things simple. We'll look at an example where there is a coupon. It doesn't change anything. The relationship still holds. So, 2 bonds, a 1-year bond and a 2-year bond. So keep in mind again, they are zero coupon. So the price of 1-year bond is simply 100 divided by 1 plus S1, 3%. So we're discounting the par value for 1 period, and the 1 period rate is 3%. Similarly, a 2-year zero coupon bond will be discounted for 2 periods at the 2-year discount rate of 4%. Oops, sorry. And that is the second price, 92.46.
Okay.
So if I buy the 1-year bond,
You keep
my
it for
investment horizon is 1 year. So at maturity, I get my $100. My purchase price was $97.09. My selling price is 100, and my realized rate of return is exactly 3%. So my holding period matches the maturity. It is 1-year bond. I get my 3% 1-year rate.
And nothing's changed, okay.
Now, what if I buy the 2-year bond and I hold it for 1 year? Remember, I still have uncertainty about the price of this 2-year bond 1 year from now. 1 year from now, this bond will not give me my par value. It does not mature. It is going to have an uncertain price in the market.
Yeah.
It will become a 1-year bond at that time.
Yeah.
So if a 2-year bond, and let's assume 2 scenarios about the future spot rates. So 1 year from now, what the spot rate is going to be, we don't know. It is uncertain. So let's suppose the spot rate is 5%. And this is not random selection. It corresponds to the forward rate that we already calculated that was available at inception at time 0. So if the spot rate 1 year from now is exactly equal according to those implied by the forward curve, 5%, then the price of that $100 bond now with a maturity of 1 year will be 100 divided by 105, and that is my 95.24. So I'll sell the bond. And so my return, there is no coupon, so 95.24 divided by 92.46, selling price divided by purchase price minus 1 period, so I don't need to apply any square root or third root or so forth. We don't. It is already in annual terms, and we get a return exactly 3%. And this is not surprising. This is mathematically true, and so it will be exactly the same as the 3% our 1-year spot rate. So my holding period return, if the spot curve evolves
as expected
to be exactly the same as the forward curve at inception, then I would basically make the same 1-year return. Now in scenario 2, let's suppose the 1 year spot rate 1 year from now turns out to be 3%. So it stays the same as the current 1 year spot rate, not corresponds to the 5% forward rate that existed. So in that case, the price of that bond, remember it was originally a 2 year bond, we are selling it after 1 year, so now it is a 1 year bond. So the price will be 97.09, which is 100 divided by 1.03. And my realized return is higher at 5%. And that is the strategy employed under rolling down the yield curve that we are going to talk about. We'll look at an example with coupon bonds as well. So there is no arbitrage profit. It basically is, as an active trader, as an active bond trader, my expectation vis-a-vis the market's expectation. Market's expectation is embedded in the market price, which is the forward price today. And in this case, forward rate, 5%. But if my expectation of 1 year rate 1 year from now differs from market price, which is the 1 year forward rate 1 year from now, if that is different, then I can trade and try to beat the market, try to make extra return. But if my expectation turns out to be wrong, I can lose money as well. So it's not an arbitrage transaction. It is simply a transaction based on my expectation vis-a-vis market's expectation. And that applies to any investment. It could be for stocks, it could be for options, real estate, whatever. So the active manager, and that is what the second bullet point is, will try to outperform the market by predicting how the future rates will be different from those predicted by the current forward curve. So if my expectation is different than what is the current forward curve, I can execute trades to try to take advantage of it, assuming my expectation is more accurate than the...
Okay.
Well, hello friends and welcome to Hello friends and welcome back. We are ready to talk about the second bond 1 year from now. We can lock in that rate through market transaction. Now, if the spot rate at time period 1 is exactly the same as that forward rate, particularly looking at your bond, certainty of how that bond will, now, is keeping that, okay, your bond forward curve spot rate is 4%, and so doesn't change zero coupon. So the price of 1 year bond, similarly a 2 year zero coupon bond will be discounted for 2 periods. My purchase period matches the 1 year from now. It will become is exact or 6 sizing. This is if the spot forward rate that exists is higher. There is no forward price today, which is the 1 year transaction, and that is what the second bullet point is. We'll try to outperform the market by predicting how the future rates will be different from those predicted by the current forward curve. So if my expectation is different than what is the current forward curve, I can execute trades to try to take advantage of it, assuming my expectation is more accurate than the market's expectation. And if future spot rates are below the current forward rates, so if it turns out that the forward rates were too high, market was wrong on too high rates expectation. Well, then buying a longer term bond is great because that bond will appreciate in price, greater return by buying a longer, greater than 1 year risk-free rate. You buy a longer maturity bond, and you basically you beat the market. You earn higher rate of return, as we saw. In our example, in scenario B, we were able to earn 5% while 1 year risk-free rate was 3%. All right, now spot and forward curve relationship. The bottom line here is the spot curve. So the bottom line is the spot curve, and then each line above it is different forward curve. So what is the difference? They have different values for J. J is basically the lag in the forward rate. So if J1 is 1 year from now, J2 may be 2 years from now, J3 is 3 years from now. Remember FJK. J is the time out in the future at the inception of the loan. So more distant the start of the loan is, higher the value of J. And in an upward sloping yield curve, we already talked about this, forward curve is above the spot curve. But not only that, more distant starting forward curves, meaning where J value is higher, will be successively even higher forward curves. So the plot along each of these curves is different values of K, but the J along this entire curve is the same. It basically tells how lagged the start of the loan is. So the forward curve is reliable, the spot curve, and more distant the forward rate is, the more distant the inception of the forward rate is, higher the curve. This is true for upward sloping, exactly opposite for downward sloping spot curve. The forward curves will be below the spot curve if the spot curve is downward sloping, and more distant forward curves where J is higher will be further below, or will be successively lower forward curves. All right. So let's look at a quick example from the curriculum. When the spot curve is upward sloping, the forward curve
is above.
Should be above the spot curve. Yeah. So it's very straightforward. Choice A. We already know this. All right. Moving on, spot and forward relationship. When spot curve is downward sloping, now we are changing the value of J.
When the spot curve is downward sloping, a later initiation date results in a forward curve that is Okay, when the spot curve is downward sloping, it means sequentially it gets lower, which means a later initiation date results in a lower curve and a lower forward curve, because when the spot curve is downward sloping, the forward curve is going to be below it, which means the forward curve is below the spot. So this is the spot, this is the forward, and then you've got later initiation dates, which means the distance is going to be higher. Later distance below
Later.
C.
So later J means higher J. Okay, results in a forward curve
below
that is closer to the spot curve or greater distance from the spot curve.
Greater distance.
Now remember, it is downward sloping, so it will be greater distance, but not above. It will be below the spot curve.
Yeah.
So the correct answer is C. It will be at a greater distance below the spot curve. Now, if future prices evolve as forecast, we already talked about the return. It will be exactly the same as one period return and so forth. But now we are talking about forward price. And so if the future spot rate evolves as forecast, the forward price will remain unchanged. And essentially, forward price is for specific points in time, and therefore, if the rates are as expected, the price will not change. If future spot rates turn out to be lower, inverse relationship between bond prices and rate. If rates are lower, prices will be higher, even the forward price will be higher. So for a bond investor with a 1 year return, 1 year risk-free rate, if spot rates evolve as specified, if not, it will defer. And so that is why we are using active management to outperform the expectations of the market.
When spot rates turn out to be lower, forward price will increase.
Okay. Now let's look at an example about return 1 year risk-free rate if spot rates evolve as specified. If not, it will defer. And so that is why
I'm so tired. I want to sleep, but my bed isn't made.
we are using active management to outperform the expectations of the market. Now let's look at an example about what we just learned about forward price. So bond will be overvalued if the expected spot rate is equal to the current forward rate.
Nope.
So if the expected spot rate is equal to the current forward rate, the bond will be
changes.
fairly priced.
Yes.
If the expected spot rate is lower than the current forward rate, we saw it in a numerical example, the value will be higher, and we are looking for overvalued, meaning the price at inception. So the price, the bond will be overvalued if the expected spot rate is higher. We don't want to buy that overvalued bond. So you got to be very clear. Overvalued securities in general, doesn't have to be bonds. Overvalued securities are dogs. You want to buy undervalued securities to make a healthy extra return, a healthy alpha. So if you're buying an overvalued security, essentially you're buying a dog, and you are saying that you are paying a price higher than justified. So if the future spot rate is lower than the current forward rate, the bond would be undervalued. That is not true. That is not what we're looking for. We're looking for overvalued bonds. So the expected spot rate is higher. If things are going to be worse, well, buying the bond at the current market price is not a good idea. So if the expected spot rate is higher than the current forward rate.
Yeah, you wouldn't want to lock in.
Now, suppose you have a flat yield curve of 6%. So yield curve is flat, which means spot and forward rates are all flat, all equal to 6% regardless of maturity. Now, a 3-year bond was issued at par, which means it was paying a coupon also of 6%. Par means coupon rate is equal to yield. And the first coupon is about to be paid. What is the expected return if the yield curve 1 year from today will be flat at 7%? So yield curve.
Okay, so he's got his F11 is 7. We've got payment is 6. We've got I is 6. We've got N being 3. We've got which of them being 100. What is his expected return? Okay. It's gonna be P2 over P1 minus 1. We've got P1 is equals to 100. So P2 is equals to 6 over 1 plus 6%. 100 plus 6 over 1 plus 7% squared. Did I get that wrong?
Curve is jumping up. You purchased a bond when the yield curve was down at par. So if the yield curve
Isn't any wrong?
rises to 7%, what happens? Well, first you're going to calculate the value of the bond, and the bond would be worth 104 point.
It's a 3-year bond, but I only did 2 cash flows. That's why I messed it up.
19. This is, remember, just a little clarity. Before the first coupon is paid, so there is an additional $6 of coupon embedded. Normally, when the yield is higher than the coupon rate, the bond should trade at a discount, and it is actually trading at a discount, except the coupon is yet to be paid, so we are adding that extra $6. Well, in 1 year, that translates into a return of 4.19%. And so you earned less than your expected return, which was 6% at inception. You saw the yield curve at 6%, you purchased a 6% bond, and you paid par. But because the yield curve moved adversely, you lost and you earned a lower rate of return. A forward contract price will increase. We are looking for increase in forward price if spot rate evolve
as predicted.
No.
Of course not.
Well, then the forward contract price will remain the same. Choice B says if future spot rates are lower
than what is predicted.
And that is the correct answer.
Yes.
Remember the inverse relationship in price and
Yield.
rates. So if the rates are lower, the price will increase, and that is what we are looking for. If the rates are higher, the price will decrease, not increase. All right, that brings us to the second LOS and an important concept of active portfolio management called the rolling down the yield curve. So what happens is when the yield curve is upward sloping, we know that the forward curve will be above the spot curve. And sometimes managers think that in the future things are not going to change. In other words, the forward curve is predicting rates to be too high. So what you do is you buy longer maturity bond and you sell it prior to maturity. You are rolling down the yield curve. So remember, on my yield curve or spot rate curve, maturity is on the horizontal axis and rate is on the vertical axis. So as you move, as the bond gets older, the maturity of that bond will come down. So a 10-year bond will become a 9-year bond 1 year from now. And the 9-year rate, if they are still the same, so
is lower.
Here is my 9-year spot, S9. And if I were to draw the forward curve, I will not have these early points in the forward curve, but the corresponding 9-year would be higher. So if the rates don't change, meaning the spot curve just remains the same, it evolves such that the 9-year rate 1 year from now is less than the previously calculated 9-year forward rate. If that occurs, you can make an extra return, but it is not an arbitrage transaction. It simply is a gamble on evolution of the spot curve. So it increases interest rate risk. So here is a mathematical example of a coupon spot curve. So it increases interest rate risk. So here is a mathematical example of a coupon bond. So investor has a 5-year time horizon. Two choices: buy a bond maturing in 5 years' time, buy a 30-year bond and sell it after 5 years. Both bonds are 3% coupon bonds and have $100 face value. They are risk-free, they're treasuries. So because the coupon rate is same as the yield to maturity for 5 year, the 5-year bond will be trading at par. And the yield curve is upward sloping, so the longer maturity bonds have a higher yield, and because the coupon rate of 3% is less than the yield on those bonds,
they're trading at a discount.
as we see in the data given to us. Now, so your two choices: buy a bond maturing in 5 years' time. So you buy this 3% coupon bond, and you pay $100 for it. You hold it for 5 years and see what your return is. So investor that buys the 3% 5 years to maturity earns a coupon of 3%. They paid $100, they get back $100 par value at maturity, no capital gains. This is a 3% coupon every year, which is essentially 3% annual rate of return. The second the second option is buying a longer maturity bond. Instead of 5-year bond, you're buying a 30-year bond, and you're selling it after 5 years.
When it's a 25-year bond.
So what happens? And we are assuming the spot curve remains the same. So 25-year spot curve is 4%. And remember, that price is $84.38. So you purchase the bond. Again, purchase price is given to us $58.71. This was the price at inception. At time zero. So your purchase price $58.71 is given to us. Selling price is basically the same as the price of a 25-year bond. This assumes that in 5 years' time, 25-year rates are still the same as before. It was an upward sloping curve. Forward rate for a 25-year period would be higher, but because of the evolution of the spot curve over 5 years, they are not. They remain the same. So you're going to make extra return. So the capital gains here is $25.67 on what you buy the bond versus what you sell the bond. And you still get your 3% coupon on that bond for 5 years. So you make an additional return. We're not calculating here the percentage return, but you see that if you're rolling down the yield curve and your assumptions and your expectations pan out, then indeed you will make money. Now let's calculate the realized rate of return in this scenario where we are buying 30-year bond. So remember, we bought the 30-year bond and we sold it after 5 years. So we have 5-year investment horizon, n is equal to 5. Present value is what we paid for the bond, $58.71. Future value is what we sold the bond for, $84.38. And payment is $3, the coupon we got. So your realized return is almost 12%. Compare that to the 3% if you had maturity matched, where you're buying the same maturity as your investment horizon. Again, these are just hypothetical examples. It is not a risk-free transaction. Rolling down the yield curve is not a holy grail of making money. It is simply a trade based on expectations that differ from the market prices, specifically the forward rates that the bonds are trading at today. All right. So coming back to the rolling down the yield curve strategy is buying buying maturities that are longer than an investor's investment horizon.
Yes.
So there are 3 specific conditions that I need to have for executing rolling down the yield curve successfully. Number 1, that you are buying maturity that is higher than investment horizon. Second one is yield curve or spot rate curve is upward sloping. And then the third condition is actual future spot rates are less than the forward rates at inception. So either the spot rate curve is stable, just like before, or even if it is unstable, still the rates are lower than the forward rates available at the time of the investment, well, you will earn a positive profit. So those are the three conditions. Here we are looking for a bond with a longer maturity than the investor's investment horizon. We are only focusing on the first condition here in this question. All right, so continue the good work.
I'm gonna do one quiz and then I'm done. Then tomorrow, senza swap curve, study masterclass ne quiz, ne spread measures, study masterclass and quiz. Yeah, those are the two we're doing. Look, there's so much. And it's tiring because you have to actually think. Okay, there's only two questions here. If the future spot rates are expected to be lower than the current forward rates for the same maturities, bonds are most likely to be. If future spot rates are expected to be lower than the current forward rates, future spot is going to be lower than the forward. Bonds are most likely going to be, so when is spot lower than forward? So spot is lower than forward when it's a if the yield curve is upward sloping, then spot is always lower than forward. Okay, so future spot rates are expected to be lower than the current forward. Yes, bonds are most likely to be fairly valued, correctly valued. Yeah, if it's an upward sloping yield curve, then that is the base. What study provider do I use? Kaplan, Schweizer. And you? Okay, guys, we're gonna finish. We're just doing this 2-question quiz, and then we're done. And then tomorrow we're back for swaps early morning, maybe 7 a.m. Yeah, I think I want to study up until 10 tomorrow because I want to go for a cycle. I think correctly valued. The strategy of rolling down the yield is most likely to produce superior returns for a fixed income portfolio manager investing in bonds with maturities higher than the manager's investment horizon when the spot rate curve is upward sloping. I got 50%. The first one I got wrong. If an investor believes that future spot rates will be lower than the current forward rates, then the investor will perceive an opportunity to purchase the bonds at an attractive price as the market is discounting future cash flows as too high a discount rate. The bonds are thus undervalued by the market. Okay, I got the second one right, at least. Just doing corrections. Done. Yeah, I did very well today. This week even. I'm still on 16%, mind you. Yeah, I'm on 16%, guys. U World. Let me look it up. I don't know it. Oh, U World Finance. Oh, I see it. Let me see how much it is. $600. They really be charging a lot. Huh? Okay, guys. Back tomorrow. Let's try for 7 a.m. We're gonna try and push. I want to say up until 10. We just want to do the swaps. Swap curve, the notes, swap curve, the masterclass, and then the question bank. And then, yeah, I'm tired now. I just want to watch reality TV and think about nothing. Back tomorrow. Well done on the good job.